Hello, welcome to TBFSI.com. My name is Amol Dethe, and I'm in conversation with Shanti Jain, MD and CEO of Indian Bank. So glad to have you. When I was going through the quarterly results, in fact, most of the banks have done pretty well. The credit growth has been looking really nice. The NP level is absolutely down, and the overall credit growth, specifically for all the banks, actually looks quite robust. Specifically for you, also, your second quarter results are quite remarkable, specifically when we talk about the profitability or profit after tax. I want you to just tell us to begin with, which are the sectors or which are the major contributors, behind this growth, sir.
Thank you, first of all. Now, we have grown 12% in the credit.
Right.
And the 12%, basically, we have grown 12% in RAM. RAM means retail, agri, and MSME. So retail, we have grown by around 14%, and the growth is backed by the housing loan growth, backed by the auto loan growth, and the personal loan growth. Likewise, in agri also, we have grown around 16%.
Right.
And agri, all whether the crop loan or investment credit or agri infra. Likewise, MSME too, we have grown around 5-6%. Corporate, we have grown 11%. So 12% growth, first side. Second point is we would be able to maintain our 41% CASA, domestic CASA. So one side, we will be able to contain our cost, and on the other side, the credit has grown. As a result, what happened, our NII has grown by 23%. So
Right.
NII growth of 23%. Second is the non-interest income growth is also there. So our fee-based income has grown by 11%. Recovery is more than 6%. PSLC commission has increased. So there is a growth in a NII, growth in a non-interest income. Expenditures will remain controlled, and at the same time there is reduction in the provisioning. Provision for NPA credit cost has come down 0.8%, resulting into a good growth in the net profit and the operating profit. So you can say our growth is based on our NII growth, and that backed by business, so sustainable growth.
Noted your points, and I copy that. It's a sustainable growth for you and almost all the banks right now. In fact, this is the best of the times for the banks which has come in the decades. Must say that. But I want you to explain more, specifically on the RAM side, and tell us, what is actually driving RAM growth right now? Is it because the interest rates are still quite reasonable compared to what it was earlier? I mean, earlier it was obviously cheap, but now they know that it will remain constant for a couple of months. That is one. Second, the festive demand is there, and third, overall there is a positivity in India. Are these the reasons, or something interesting happening specifically in this particular segment, sir?
The big picture is that country's growth is there, GDP growth is there. So economic progress of the country is a main factor. Then you come to the interest rates. Interest rate also, banks are offering very, very competitive rates in housing loan or auto loan. In spite of reduction of repo rate by 250 bips, all have not been passed on to the housing loan or auto loan. We are giving housing loan to best customer at 8.40%. So better rate we are offering. At the same time, the sector itself has become clean with the RERA and also housing loan. So there is a good growth in the housing loan happening. In the auto loan too, there is a growth, and it is a continuous growth in auto loan because people are moving to SUVs, good vehicles. Now the income level of the citizens are growing. Middle income group is growing in the country. As a result of this, the demand is increasing. So and third one is the demand for even for the unsecured personal loan as well, because our customers, salaried people, because their income is growing and consumption driven economy. Ours is a consumption driven economy, resulting into a demand for their personal loan, for even for their other expenditures. So there is a growth from all these sectors. Second one is the festive season. You rightly said. Now we have also made processing fees waiver for a festive period. So processing fees for housing loan, auto loans. All this will further contribute to the growth of the retail sector. So this I can say with the country's growth, the growth of the economy, growth of the income level, resulting into a growth for retail credit in the country, and the banks too are offering a better rate. So all these factors are the main drivers for the growth.
If you could share some outlook in terms of how long this growth will continue, specifically for retail as well. And if you could also give some sense in whether the corporate growth is also the same for you and how is the pipeline looking like?
Now, what happens, the growth, if I'm seeing my month-on-month basis, sanctions for housing loan or auto loan sanctions are increasing.
Right.
So growth is there, growth will be there, and we too are offering it a better rates, right? And slowly, we are also getting all enablers are in the market. So you can see the CIBIL score, you can see the credit information company score, you can see the income, you can see even the aggregators and all. So all things are in place. So as a result, it is easier for banks to take a credit decisions.
Right.
This is one fact. So this growth will be there. In a corporate, what happens, the interest rates have increased, and you see there is a difference in the credit growth and the deposit growth, right? So the credit growth is happening, deposit growths are little bit weak, lower than the credit growth. So as a result, banks cost is increasing. So in a corporate side, we are aggressive when we are getting a margins. But going forward, since the public government expenditures have increased, naturally private expenditure, private investment will also increase. Slowly the growth will come. Even though presently we are getting a good growth from the infrastructure segment, we are in the textile sector, in the steel sector, in the cement sector, even the smart metering sector, in the renewables. So proposals are coming, sir. But wherever the margins are available, we are going.
Okay, noted your points. Now let me shoot one more question specifically about the NPAs, which is always an integral question for us about the bad loans. So when I look at your results, if I'm not wrong, your current net NPA is around 1.5%, and maybe I think your provision ratio has slightly increased to some 456 BPS points. So how do you see or what is your outlook specifically for the NPAs right now?
No, the net NPA was 1.5% a year back. Today it is 0.6%.
Okay.
Even the last quarter it was 0.7%. So the NPA numbers are coming down. What is happening over last year also, you see, my slippage was 6,600, my recovery was 8,500. So last year, whole 4 quarters, our recovery was more than slippage. In the current half year also, the slippage was 3,700, the recovery is 4,200. In current half year also, the recovery is more. So one thing is, when your recovery is more than slippage, your number will come down. First point. Second point is, when your net NPA is close to 0.6, so going forward, your credit cost will be substantially lower. So these are the two major points. Third is, my provision coverage is 95%. So whatever you recover, at least there is a reversal of around 95%. So it gives you a profitability as well. So all these numbers are good. And the going forward also, if you see the risk of a further NPA, so it is measured what is your collection efficiency, what is your SMA 1 and SMA 2. So my collection efficiency, we are maintaining around 95+% collection efficiency, and our SMA 1 and SMA 2 numbers are come down rather. Even corporate, the SMA 1 and 2 is even in 0.19%, very, very less. So when your recovery is good, your SMA numbers are less, your net NPA is coming down. So going forward, that kind of risk is not visible at this point.
Okay, sure. Now, slightly, I will move the focus to the industry, and again, then I will come back. When I look at the industry at the large, though the Reserve Bank has kept the rates almost at the similar level since long time now, but the cost of funds are still a challenge for banks because of two reasons. One, the rates are stagnant, but they don't know when the rate will go up, and there are high chances that it will go up very soon. And we see some impact on the corporate growth because the capex cycle of the specifically corporate India is not as high as it should have been or as it was expected, considering the economic growth. So how do you see this, tantrum? How do you see this whole situation right now?
So you rightly said. So the credit growth is 12%, 13%, even the 15%, and deposit growth is less, right? As a result, what happens when your credit growth is more and deposit less? There's a widening, right? This is one point. So you need money for further growth. First point. Second point is when in an increasing interest scenario, what happens? Some of the deposit moves from the CASA to the term deposit because the different interest differential was there. When earlier when we used to give FDR rate at 5%, 5.5%, and the deposit rate was a saving deposit rate was 3%, the differential was 2.5%. Now the interest rate at 7.5%, so differential has become 4% or 4.5% is against 2.5%. So when the differentials increases, people will move to the term deposit. First point. Second point is that all banks have given mobile banking and all. So it is very easy even for the customer to move from saving deposit to a term deposit with the one click of that. So in that situation, what happens? Your cost of deposit increases. Third one is what happens in a repricing when you are moving to an interest rate increase cycle, the deposit get repricing and it is increasing quarter after quarter because some of the deposit will reprice, then next time some more will come. So then the cost of deposit will be peaking. This happens in a increasing scenario. So your cost of deposit is increasing, whereas the yield on advance is not increasing to that extent, and there is a pressure on the margin. So we have seen the results of all banks so far has come. You see that there's a slight compressions in the margin, but you see the compression of the margin today vis-a-vis the last year. Suppose in my case, I see the last year margin was 3.41%. 3.41%. Today I'm at 3.57%. So even if the margin with slight bit compression, we will be able to protect our last year margin. And we are passing through the interest rate cycle. It will happen, sir. But the fact remains the banks is able to maintain its margin is a big thing. So we are able to maintain, and we at the beginning of the year we said that our margin will be 3.41% plus minus 10-15%. 3.41 is the last year margin. So we are at 3.57. So we are better off the margins. But cost of fund naturally will slightly increase, sir.
Okay. Let me just slightly understand more on this perspective. The compression is on NII. NIM is not obviously for you. It's for everybody. Majority of the banks, except maybe one or two, because of maybe they're huge or they have some different methodologies. Will this continue? Or if yes, how long?
So actually it will continue till your repricing effect will come, right? So it depends on the duration of your liabilities. If the duration of liability is say 1.5 years, naturally entire repricing will come within a period of 1.5 years. Right? So it will come. The issue here is not cost. Issue here is how you protect your margin. Because naturally cost will increase, your yield on advance will also increase. So the endeavor will always be to protect the margin, and margin can be protected by way of increasing your investment income, increase in a yield on advances, and how you are pricing your products that you are, suppose majority of your loans are in a MCLR link. So when the repo is post, but MCLR you can always increase based on your cost of deposit, right? So if your advances, MCLR link advances are more, naturally your earning will be more and you will be able to protect the margin. So in our case, around 64% of our book is on a MCLR. So what happens? Recently we increased our 5 bips MCLR. So as a result, I will get a 5 bips more margin to take care of my increasing cost. This is how, at the same time, we see the investment book also our margins are improving. So if the income side is increasing, your cost will increase, even you will be able to protect the margin. This is the crux to my mind. But the cost will increase, sir, because we are in an increasing scenario.
I think that's a very clear answer there, sir. Now I want to understand something very important. Every bank, every financial institution is betting on that is a MSME segment. Again, they are the growth drivers. That's a growth engine. Government is also looking at very positively, no doubt about it. But we didn't have a great past when you look at the MSME lendings. We have had a lot of issues there. And currently, when most of the banks are going far more aggressive, specifically on unsecured lending, in the MSME space. I would like you to tell us what could be the logic. I mean,
Okay, so
why are
MSME,
they going so
yeah,
aggressive?
you are talking about the past because of Corona and all, right? And you see, an MSME historically they were having
Yes,
that 3-4 problems, which is basically technology is a problem, capital is a problem, all along realization from the debtors is a problem. These are the historically the MSME was having this kind of a problem. So in the past, what happens? So the Corona came, so they were not having so much of capital. Of course, banks have also supported them, right? So as a result, some delinquency, RBI and banks all have supported by of restructuring. So majority of the units we could be able to succeed in supporting them, and we came out. Now your question is on a unsecured lending. What happens up to 3 crore? MSME is guaranteed by CGTMSE. If we go even for unsecured, we are having a CGTMSE cover where we can get a guarantee coverage from them. But the fact remains now most of the informations are available. So GST returns, GST information is available, so you know the turnover. Account statements are available even through aggregator and all. You can always have
right.
a watch on the credit turnover in the account. Civil scores are available. CMR 1 to 4 rankings are available. The number of tools are available now. Actually, what happens in a last 5-7 years, the ecosystem itself is changed, and the number of enablers have come to analyze the MSME in a more better way. So banks are using this, and if you are even giving some unsecured loan, because you have a visibility on the cash flow. The important thing is that suppose I know the cash flow of yours, then I can take a call. Suppose I'm getting every month the salary, then I can take a call. So all these factors are taken into consideration while giving the loan, the pre-approved business loan or a pre-approved personal loan or an unsecured loan. So one side security is intact and cash flow we know. All these are taken into consideration.
Noted your point, sir. I think that gives a detailed answer about it. Uh, but do you think that considering the interesting rally in MSME segment, it will become a profitable segment? Maybe not as strong as a car loan or something like that, but it will be an interesting pillar going ahead.
MSME is the biggest employment provider in the country. Biggest MSME is the biggest export sector in the company in the
Right.
country, and MSMEs are supplying to the corporates. So MSME will always be the center point for all banks or financial institutions in the country. And but MSME majorities are micro.
Right.
Majority are micro or family driven. And we are the bank having 6,000 branches in the nook and corner of the country. We know the customer years together. They're all family accounts are with us. So that is always give us a comfort to grow in the MSME sector. We'll continue to grow, sir.
Noted your points. Now let me also slightly shift your focus to the NBFC. I think NBFCs are also doing pretty good specified, and I think the co-lending model has been picked up with a couple of NBFCs and banks partnerships. How do you see and review the co-lending model right now?
Actually, co-lending, there are two models in co-lending itself. One is akin to the pool purchase, second is a technologically, and we are able to give a
Right.
blended rate to the customer or a product. So second, this first method is yet to pick up because technological advancements are yet to take place in the country.
Right.
So as to give a blended rate and on simultaneously, because we have to integrate fully with the NBFC, then only you can have a blended rate and so the second model everybody is going, it is akin to pool purchase. So what happens, the NBFC have a wider reach
Hmm.
in the
Hmm.
country. First point. Second point is that the recovery is also better. The recovery.
Okay.
Third one is because of their wider reach, banks are purchasing either the pool or the co-lending. We
Right.
too are, and I'm telling you, co-lending second method vis-a-vis are more or less same. So we too are aggressive there. Here,
Huh.
basically, every bank is doing the cherry picking based on the CIBIL score or based on the CMR ranking, right? Or based on the security or based on the geographical area. So every bank is aggressive. We too are aggressive based on that.
Sure. Now let me specifically talk about the fintechs, which is again a very, very interesting area. and they have been partnering heavily with the banks and the financial institutions. How are your partnerships shaping up with fintechs? Are they with you? What you can say in a collaborative partnership model? How many fintechs are you working with?
Okay, so first point is that the technology is the future. There is no second opinion. So what we have done, we have in the IT department, we have met number of GMs, fintech partnership, collaboration, and all. Right. This is the one, because for every operation you need a partnership, and we to have a middleware. Through middleware you can have a API integration with all. So with the fintech is also with the company, we are having number of API integrations, and based on that we are offering products. We are giving MIS online on an agreed frequency. Even for a digital lending, we are having a digital lending. Today we are having around 30,000 crore of a digital lending book, and which we are growing. So for a digital lending, you need to have a fintech partnership to assess the credit needs, right? To know the 360 degree about the customer.
Right.
So we have a fintech integrations for payment, right? For even the credit assessment, number of vectors. So we are having number of alliances, partnership. We are virtually having number of partnership with the state governments, number of departments even. And in the middleware, we can have number of partnerships. Even I can tell you, we have a partnership for even, suppose we have taken a auto loan, I have a partnership with the Vahan and I can get everything. I have a API integration with Aadhaar, income tax, GST, all this. So this is the required, and today if you are offering a digital products, and we have so far around 63 journeys we have launched. So we are providing even gold loan, we are providing even housing loan, we are providing auto loan, pre-approved personal loan, we are giving loan based on the GST returns, based on cash flow, and all is happening through this fintech partnerships and all.
Okay. But like many financial institutions and large NBFCs and banks, what they are also doing, sir, is they are also trying to acquire some stake into the fintechs. They're also trying to have them as part of them because they are working them so closely. By any chance, do you have any such plans that maybe you will acquire some fintechs, maybe you will buy some stake into those fintechs? Because for them also to expand, capital becomes a big challenge, and since they're working with you, it could be a solution. So, are you thinking in that direction?
So what we have done, sir, in all public sector where we have created PSB Alliance Limited.
Right, right.
Where the public sector banks have contributed as a capital. So
Right.
PSB Alliance is doing number of jobs for us. Right. So he is doing for doorstep banking, various products in door. Now he will starting the e-Vikray. He will be doing number of for cyber. He will do number of jobs for us. So the PSB Alliance will do for sector as a whole. If you do a particular company for your bank, so that it may not be viable on that. Suppose all 12 banks, including State Bank, Bank of Baroda, Indian Bank, all we have contributed there.
Thanks for adding that. I'm aware about it. But now, one more last question maybe, and if there is anything that you want to add, I would be really happy to listen to you. A very important question in terms of the outlook or the future, sir. Next 6 to 12 months will be very critical because in next 3 months we will have a union budget coming up. After union budget will be followed by a Lok Sabha election, right? And the whole country is going actually thinking and preparing for the election now, the union budget. So a lot of big activities are going to happen on one side. On the other side, the geopolitical tensions are still very high. We do not know how the results will be, in which direction the Fed will move, and how will it translate specifically with the central bank here in India. Considering this background, how do you see maybe India's economy and specifically the banking growth for next 6 to 12 months? What kinds of changes do you see? What kinds of differences do you see? And how do you see the overall, future for next 6 to 12 months?
The first thing is, sir, we are a consumption-driven economy.
Right.
This is the first fact. So our even domestic demand is so huge, so huge. So the way the income levels are increasing in the country, the way the economic progress is happening in the country, the way the huge investments is happening in the infrastructure segment, whether it is a road, it is other infra, even renewables, right? and with the city gas, with even the electric meters, so the number of things that country, the progress is happening in the country. So that demand will be continuing for our country. And when this growth happens, automatically the incomes of the citizens too is increasing. What is people are buying houses, those who are in small houses are having big houses, right? So this demand will continue, to my mind. So if the demand will be continued, naturally the banking sector will be continued. First point. Second point is that with the way government is making public investments, right? The way the Gati Shakti and monetization of big projects are coming in the country, right? So the growth is likely to happen even in the rather, I'm telling you, the entire Amrit Kal, 25 years. Age against 1 year, if you see the entire 25 years, this is a good time for us in India, because India too will be growing from the developing to the developed. And in this, there are a number of infrastructure is required. So virtually, this is a good time. The balance sheets of the corporates are cleanser. The leverages have come down substantially. Banks' capital adequacies are good. As against, suppose in my case, as against 11.5, I'm at 15.48 with profit around 16.5. 150% of the required capital I am having. So my profitability is there. Net NPA is 0.6. So very strong balance sheet, corporate strong balance sheet. Good time for the country to grow. So I think there are the huge opportunities for us to grow domestically, even internationally too, because of course the problem is there in some part of the world, but still there are huge demands, sir. Huge demand. And demand if you see the long-term perspective, maybe 6 months or 1 year perspective is different, but if you see in a long-term perspectives, so it will be to my mind, it will be a growing. So good time for us. You see that in the results of the bank, you see all banks are having NPS historically low, and banks NII growing, capital is 150%. Earlier we were having that kind of a problem, twin balance sheet problem. Now the twin balance sheet strength is there. So considering all these, I'm seeing a good time, further good time for the banks.
Sure, sir, that was quite meaningful, and really delighted to hear the positive and optimistic story about not just banking but the whole economy as such. So considering the innovations happening in the banking and finance space, I want you to tell us, how are you reskilling your people? How are you onboarding new people? And what are the actually changes that you are doing into specifically the HR segment of your bank? If you could add on that.
Yeah. So in HR, basically, 3-4 things we have to do. One, which we are doing. First is a skilling and reskilling of people, right? So the training part, domestically, internationally, our training college, other banks training college, country's best training college, we are sending our people. First point. Second point is what happens, the requirement itself is changing. Earlier, suppose data mining, right? Data analysis. Digitally we are doing number of things. So we are recruiting people from the market also for all levels, even up to the GM levels. So cyber risk and all, these are all coming risk. So we are recruiting people from the market also, so that we need to have a fresh thinking in the organization. Third one, to groom our people, lateral hiring also we are doing at all levels. Suppose we need a people for credit, we need a people for Forex, we need a people for treasury, we need a people for risk. All this we are hiring also. The third point. The fourth point is that the average of the organization itself is 38 years. And now what happens, whatever you recruit a people, majority of the people are engineers are coming.
Yes.
So the technologically also they are very sound. Last year we recruited 3,000 people.
Right.
And 1/3 or 1/4 comes very engineers and all. They are very, very knowledgeable people. They understand technology and all. So all this, what happens with this, all this, the entire environment of the organization also changes.
Right.
And this way you can make the bank future ready. Second one, what we have done in HR transformation, we have given the KRA of each and every of the bank. These are your key responsibility area, and performance is just based on the KRA on a monthly basis.
Okay.
So we have created a KRA dictionary, what kind of role he has to play, what is expected from him, how we are giving the targets based on the growth in the particular segment. So how the market is growing, how the competitors are growing, everything taken care in our HR transformation project. So big thing we are doing in HR side to make bank future ready. So HR is important, and from technology also we are making huge investment in technology, in a cyber side, even in a branches computer side, even in a cloud. All things we are making. So one investment in technology, one investment in HR, right, and the better products. As a result, we are making bank future ready.
Thank you. Thank you so much for your time and the contribution. Thank you so much for sharing your perspective here. And thank you so much for watching etbfsi.com. Stay tuned and stay connected to etbfsi.com. Thank you.